How do you improve your credit score when you can't get approved for credit? Hello and welcome to episode 8 of Money Anonymous. I'm Kira Jones, financial coach and founder of Financial Intervention Academy, here to answer your personal finance questions anonymously. And now on to today's question. I'm wondering how to increase my credit score if I can't get qualified for a personal loan or a credit card. I know to pay off my bills on time, no bankruptcy, repossessions, or anything severe. I'm 31 years old and don't have a huge credit history. I just have school loans and a couple very minor collections I'm paying off this spring. But after I pay them off, won't I still be considered a risk for the next 7 years regardless? I'd like to be able to buy my own home in the next few years. I don't know how to start over if I can't raise my score. Will paying all the collections increase my score? They're marked as closed. I have 2 or 3. I had a financial decline last year and battled for my apartment, so I had to let them go to keep my home. I tried using my car as collateral today to get a small loan and still got denied. So the first step to credit repair is to figure out what factors are hurting your score the most. So let's talk about credit activity. Aside from the collection accounts, which is probably what is hurting your approval odds the most, I would first look at how many hard inquiries do you have. Hard inquiries stay on your report for 2 years. And if you have 6 or more, you can pretty much forget about getting approved for anything from anyone. The more recent the inquiries, the more harm it does to your score and approval odds. It's ideal to wait at least 3 months in between hard inquiries. So as an example, if you have 4 inquiries that are about a year old and you have 2 within the last 3 to 6 months, then I would highly suggest that you wait a full year before the old 4 inquiries to fall off your report before you apply for anything new. But then your 2 new inquiries will now be over a year old and should be the only 2 inquiries left on your report. This will drastically improve your approval odds. The other immediate info to assess on open credit lines is your debt to income ratio, how much of your monthly income is going to debt payments, credit utilization ratio. This is how much you have spent per card relative to their credit limit. An ideal DTI to aim for is less than 36%, but you can probably still get approved financing for certain types of credit with a DTI of 42% or less. On the other side of that coin, a debt to income of 50% or more, you're very unlikely to get approved by anyone for anything. The ideal credit utilization to shoot for is 30% or less, and the worst utilization score is 70% or more. Now, to explain the phases of delinquency so you can better understand your debts and collections. All credit lines will be in one of 5 different statuses: open and current, open but past due. It's usually any account that's missed 1 or 2 payments. The account usually closes after the 3rd missed payment. This is what usually screws people's DTI ratio up because your available credit limit goes away, but it's no longer an account you can ever use again, but you likely have a large unpaid balance. Then if you fail to make a payment arrangement with the original creditor and the account falls 6 months past due is usually when an original creditor will charge off the account and send it to a third-party collection agency. The last and worst phase is if collections efforts turn into legal efforts, meaning the legal agency or the collection agency will file for a judgment against you with the courts. This could give them the ability to put a lien on your home, garnish your wages, or levy money sitting in your bank account. Now, for collections accounts, they are that are just closed, usually 3 to 6 months past due, or are they charged off 6+ months or past due, or how long ago did they charge off? If they are just closed, here is something to consider. A closed account is still accruing interest and penalty fees. So if they won't work with you by lowering the interest rate temporarily and help you with a monthly payment plan or hardship program, then it might be best to let this card charge off. This at least stops the bleeding. The balance isn't getting any larger and you can work on settling or paying it at a later time. Disclaimer, I still would need several questions answered about your debt, balances, and situation before if I could tell you paying those collections would help you or not. I worked over 10 years in debt collections and can tell you only about 15% of debts ever wind up in legal action, aka judgments. There are only 3 reasons I ever approve my clients to pay a charged off debt: either to avoid a judgment or that legal action, to improve your credit score because you need to get a mortgage or an auto student loan. All other open and current consumer debt besides a mortgage is paid off, and usually that client has some moral reason for wanting to pay the debts, and it won't fall off their credit report for another year or more. Now, what I will tell you is that the most recent 6 months of your credit activity is the most important factor in your score. If over the last 6 months is when things started going delinquent and accounts started going past due, closing, charging off, maxing out revolving lines of credit, applying for a bunch of loans, racking up a bunch of those hard inquiries on your credit report, then yeah, I think your score's going to suck. But credit scores heal really quickly when you take care of what's negatively affecting it. Hence why I stress that the most recent 6 months of your credit activity is the most important. As far as a house one day, I know lenders who can get a first-time homeowner loan or an FHA with a score as little as 580 or a 620 for conventional mortgage. But you would probably have, most people get denied because of bad debt to income ratio. That's the number one reason people are being denied is because of DTI, not necessarily because of their credit score. So loan consolidation and 0% interest credit cards, those are the hardest to get approved for. You likely need closer to a 720 plus score to get those, but you can get into a home with less than perfect credit score. You just have to work extra hard to get your DTI ratio down. You can do this. Don't give up hope. I am proof that credit heals really quickly when you take care of the things that negatively affects it. I increased my score from a 585 to a 696 just 4 months after a bankruptcy. And as far as you being considered high risk for the next 7 years, that isn't necessarily true. The older the debt, the less the impact to your score. I think you're talking more about the 7-year clock for when credit reporting. All paid or unpaid debts only stay on your credit report for 7 years from the date of last activity. And yes, paying the debts will mean that they won't fall off from your credit report for an additional 7 years from that date of payment. But a settlement or paid in full debt is better than an unpaid one, especially if your collection accounts are nowhere near old enough to fall off your credit report. If the collection accounts are about 5 years old, you could wait it out another 2 years to let them fall off your credit report. But if your goal is a mortgage, then paying the closed or charged off debts are crucial because mortgage lenders generally use the FICO 5 scoring model. And under that scoring model, unpaid collections are actually really bad for your score. This is different than FICO 8 scoring model that credit card issuers use. So if your goal is to get approved for a mortgage in the next 2 to 3 years, then you should do the following. 1, resolve any derogatory marks. For most people, these are collection accounts. There's a whole separate process and video for dealing with past due, closed, and charged off debts. Do you pay them in full, settle for less, etc., which is too involved to break down in this video. So unless the debt is a year or less away from falling off your credit report, you want to pay these as soon as possible. Pay down all revolving debt accounts under 30% utilization. If your goal is just credit repair and you are not looking to get a mortgage in 1 to 2 years, then I would reverse these first 2 steps. Pay down current debt under 30% first, and then you can resolve the collections accounts. 3, if you have 3 or less hard inquiries, then don't apply for anything new until you're ready to shop for lenders for that mortgage. If you have more than 3, figure out when those inquiries will fall off. They only stay on your report for 2 years. You want to know the month and year when all your inquiries fall off because you're shooting for 3 or less before you go and apply. 4, calculate your DTI ratio. To calculate it, you can pull up all your monthly debt payments and divide them by your gross monthly income. Your gross monthly income is generally the amount of money you have earned before your taxes and other deductions are taken out. Other living expenses like utilities, car insurance, groceries, internet, cell phone payments are not included. The maximum DTI for a first-time homeowner loan is 57%. However, each lender is free to set their own requirements. This means some lenders may stick to the max DTI of 57, while others may set the limit closer to 40%. You might want to do your research and speak with the lenders you're considering working with. For most people, if you focus your effort on getting your DTI down, and your credit score will naturally rise as a result. Lastly, and the most important thing that will keep you motivated to accomplish everything I mentioned so far is your why. Homeownership can be a big part of your overall why and extremely motivating. So what can you do now to help prepare you? First, figure out how much house you can afford. The 28% mortgage rule states that you should spend 28% or less of your monthly gross income on your mortgage payment. And that's principal, interest, taxes, and insurance. Now that you know your price range for a home, go ahead and start shopping for that home. What kind of house do you want? What city are you going to live in or country? What school district do you want your kids to go to? How can you make it as visible to where you see it every day? Make a vision board. Here's a very simplified version of one. I mean, down to the decor in your home. The more you can visualize what it is you're working so hard for, the easier it is to stay motivated through the boring, frugal phases of life so you can achieve big, beautiful goals like your own home. All right, folks, that is it for episode 8. If you would like to submit a question to be answered on a future episode, please fill out the anonymous Google form. The link's in the description below. And we will see you next week for episode 9 of Money Anonymous, where I will be talking about the best way to spend that tax refund. Disclaimer time. Every situation is unique, and there is never just one right answer to questions about personal finance. Everything I discuss in today's video is meant for education and informational purposes only and should not be taken as financial advice. Even today's scenario is missing very important details that I would also figure out and discuss with a client before giving them a range of options so they are fully informed about their situation and their options. Then they can decide what's right for them and their family. Thank you so much for tuning in. If you found this helpful, please give me a like and subscribe, and we'll see you in the next episode.